Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It's February 22nd, 2023. We have a brand new guest today. Really excited to talk about Mike Arnold in a second, but he's joining us for the first time, and we have a lot of stuff to talk about. Before we go too far, I do want to remind everybody trading futures, options on futures involve substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I can afford to lose doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. Be in a good spot. We make bad decisions as human beings when we're under stress. And remember, micro contracts could be your friends. Easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. Use them gingerly and wisely. We will be taking a look at the NinjaTrader trading platform today. None of this should be construed as trade or investment advice, and past performance is not indicative of future results. Any questions or comments, type them into the chat. The chat now resides on the website at ninjatrader.com/events. All right, joining me here today, live from the Chicagoland area, is Mike Arnold, who is the co-founder of Path Trading Partners. Good morning, Mike.
Good morning, Jim. How are you today?
Pretty good. How you doing?
I am doing fantastic.
Good,
Enjoying all
good.
the wonderful price action in the market.
I got to ask you though, what right away, and everybody wants to know this. What's it like? I mean, you're a co-founder with Bobby Iacchino, right, at Path Trading Partners?
Correct.
What's it like working with Bobby on a regular basis? I only get him every other week. I got to know.
There is never a boring day with Bob. Let's just put it that way. I've known Bob for many, many years. He's a character and a half, and he always keeps me on my toes.
All right, I'm going to agree with that character part for sure. I haven't known him as long as you, but I do get him every other week, and he's a fascinating fella for sure.
Yeah,
Now,
he's got a wealth of market knowledge also, so you're lucky to get him on when you do.
yeah, for sure. So now you're in the Chicago area, right? Right now, but you've been all over that. You've been in a little bit of a nomad, right? You've traveled around a little bit. Tell us about it.
Sure. Yeah. Well, I after graduating, I went to the Chicago trading floors, but then I've traded in New York, Switzerland, Vancouver, back in Chicago now. So I've done sort of the trading gambit in overseas and in the Great White North, and now I guess I still am in the Great White North.
So after all of that, you ended up round circle back in the Chicago area for at least for now. Maybe you'll move again. I don't know.
Well, Chicago will not be where I retire. Let's just put it that way.
No, I know. I fled a couple of years ago after being there for 58 years. So I hear you. I got out. But that's
You
that's
were
awesome.
smart. I didn't get the opportunity to get out yet.
You're a lot younger than me. You'll get there. But the thing that strikes me is you went to Northwestern, right? And you have an engineering degree, right? Electrical engineering degree.
Yeah, I graduated from Northwestern back in the early 90s with electrical engineering degree, but never practiced electrical engineering a day in my life.
Yeah, there's a lot of engineers in this business, right? I'm an engineer by schooling. I don't know if you know Dan Grams, who was my mentor. He was an engineer by schooling. You get that every once in a while, and there's this, easy connection with the technical analysis part, right? Because of the math skills.
Yeah, it was a good fit. I mean, not only with that, after I graduated, I went and got an internship, learning how to be an options market maker. And that was before we were still down there with handheld printouts. Okay. That's before you had your handheld even devices or anything else. So you had to do fraction math. That's before decimal trading and everything else. You were doing fraction math in your head all the time. I mean, it was just, we'd practice all the fraction math, and you'd have to do a lot of analysis in your head. You couldn't look at a screen. run technical analysis. I was essentially keeping a chart in my head. That's how I got good at charting, being able to visualize the markets, what was going on. And then after you got off the floor, or when you were off the floor, you got to verify what you were constructing in your head actually looked like the chart when you could look at it later.
Right. Yeah, for sure. I remember those days 100%. Never forget them. So eventually, though, you transitioned to the screen, right? Into the technical analysis side and trade management side on the screen, right? When did that happen?
I transitioned to the screen when I went over to Switzerland as a options market maker over in Switzerland, because there was no pit there. It was all screen trading there, because it was not a centralized exchange. You could have people in front of screens from all over Switzerland there. So that started the transition. And then when I got back, I just never, I started going into system analysis, programming systems, researching systems, and I just never really went back. There was no need to go back to the floor. So I was one of the early transitioners off the floor, whereas you mentioned Bob before, he was one of the later transitioners off the floor.
Right, right. I got it. What part of Switzerland, out of curiosity?
I was in Lausanne, right on Lake Geneva.
Okay, so that would be a combination. Would that be French or Swiss German?
It was a lot of French speaking. It was about 45 minutes from Geneva. So, and it's where the Olympic headquarters are. So it's a nice area, but it's more French and Italian speaking than German speaking.
Got it. Got it. Awesome. All right. So we've made it to the screen. We're all in on this, and it seems like you've been all in for a long period of time. You created Path Trading Partners. You're also the Chief Strategy Officer, and we know a little bit about it from Bobby. He talks about his rotation zones, your rotation zones, with this 200 simple moving average, and then 50 EMA, 21 EMA, and 8 EMA. And is that the same type of how you develop your rotation zones as well?
My rotation zones, yeah, they're the 8 EMA, the 21 EMA. The 50 is not part of the rotation zone. It is what I consider to be a target area. And the 200 simple moving average is also a target area. I like to keep things very, very simple and applicable to markets across the board. So I'm not changing indicators, changing setups, changing the way I look at the markets, whether I'm looking at the S&Ps, the NASDAQ, crude, gold, whatever market I'm looking at, I can apply the overall template to that market. And then, yeah, there are some minor nuances to different markets, but I don't have to change my overall structure of analysis.
Okay, when you say target, do you mean targets for, profit targets or stop losses or entry targets, or all three?
Targets are where I will take an action in the market. So I like to have targets before I even get into a trade. I have key levels laid out, and those key levels could be this. It hits this first level, I'm raising a stop. It hits this second level, I'm taking partial profits. It takes this third level, I'm either raising a stop again or taking final profits. Why do I do that? Because it keeps the emotion out of it. It keeps me, I've already laid out my structure. Now I just have to focus on executing my structure or watching for any counter trade that would invalidate the structure I laid out. It becomes much simpler rather than being in a trade and now trying to figure out, okay, market's moving my direction. What am I going to do? What did I analyze that correctly? Did I do this? Did I do that? No, I'm just here to follow the roadmap I've laid out.
Yeah, and emotions is the root of all evil, at least with respect to trading, right? It's a tough thing to just forget about.
Yeah, so the amount that I can minimize the emotional content of my trades, the better off I will be in executing and performing at the peak optimization. You never get emotions out of it totally. I've tried. It's never completely worked, but it helps to have targets and key levels mapped out, so you know your roadmap. It's like going on a road trip. If you're not just going to jump in the car and just start driving and not know wherever you're going. You're going to have rough destinations, and maybe even down to where I'm staying, when I'm pulling in there, and where I'm eating dinner.
Right, for sure, for sure. Well, if you got a second, let's take a look at a chart or two and kind of walk some folks through it.
Okay, sure, we can do that. So right now we have the NASDAQ futures up on the screen. And just to point stuff out here, the 8 EMA, which we already addressed, is the yellow line. The blue line is the 21 EMA. The target lines are the green EMA is the 50, and the red EMA is the simple 200. By the way, with the testing I've done, I found that generally the simple 200 works better than the exponential 200, and the exponential moving averages with the other ones I've listed worked better than the simple. That's why we use them.
So this, if I could just cut in really quick,
sure.
Mike. So what you're saying is, hey, we back tested all this stuff. Maybe we started out with the 200 EMA, and it turns out with all of our back testing and analysis, it's for some reason the 200 simple works better.
Correct. And I don't care really why. I'm not trying to fine tune things to like, okay, this was 0.1% better, but generally, it works better from our experience. So we go with what works better across multiple markets. Again, I'm stressing multiple markets. I'm not trying to fine tune things. All right, this works specifically best in the S&P, but then if I get to crude oil, it all falls apart. No, I want something that works across multiple markets, so I'm not changing my setups, changing my methodology, trying to flip everything. I can look at the same thing and spot the same kind of patterns no matter what market I'm looking at.
Makes sense. That's prudent. It's really hard to trade too many markets differently at the same time. It's just too hard to keep track of.
Correct. Yes. That's why if I love it. People, I don't know where I got this from, but I've heard this years ago, and I've stuck to it with all the systems development and everything else I've done. If I couldn't explain it to a 10-year-old, it's probably not worth trading. So I need to be able to explain, like I could sit down and somebody, a person much younger than me, and say, okay, this is what I'm looking for. And if they could grasp the concepts, then all right, I'm on to something. And then if it turns, it shifts the probabilities to my favor, then fantastic. It could be traded.
Got it. Okay. All right. So we have these lines, right? And I show my charts. I have lines all over the place. I have to explain. So we have these lines right now on this. This is a daily NASDAQ chart. I think we're looking at.
Correct. This is a daily NASDAQ chart.
Okay. So what? Yeah. Go ahead.
Okay. We use a lot of price action techniques, a lot of traditional chart patterns, but we have our own takes on it. We've done our own testings with them. But I found you don't need to overcomplicate things. One thing that we do differently than I think most other people is we do not use a lot of these lines that you see on the chart are what I call harmonic lines. They are based off of 8 intervals, so sort of like music. So instead of using Fibonacci numbers, I found out that the 8th intervals actually work slightly better for my own testing than the Fibonacci numbers. So we use these intervals like these. Instead of 61.8, we use 62.5, et cetera, et cetera. So yeah, those are the other lines I will see, because I know when we get key closes beyond key intervals, the probabilities shift to whether the markets will continue or potentially reverse their overall major trend.
Okay, so if you could explain to me, and I am like a 10-year-old, just so you know, the harmonic, it looks like a fib line, but the harmonic levels are in eighths. I remember my piano lessons from 5th grade with quarter notes, half notes, and all that stuff. Is it just simply you just divide into eighths range?
Correct. So you see here these the bigger blue lines here. Right there, you see it goes from 12 and a half, 25, 37 and a half, 50, 62 and a half, 75, 87 and a half, and 100. So I've taken the NinjaTrader Fibonacci retracements and I've made my own template, which is just the 12.5% intervals. And I watch for those are key levels. And then I'll also watch for things that I call clusters. And clusters are where you either have prior major price action, or whether I have a harmonic cluster, or whether I have a key moving average, like we cited the 50 before. So I have a 50%. This is actually a harmonic projection from a double top pattern, but I have a key moving average, the 50 EMA, lining up with a 50% double top extension harmonic, so that's a very key target area for me to watch for to take an action. So now I've laid out my next lower level for taking an action on any potential trade.
Okay, so this is you just made me smile because when we do our opening range show, I like to look at areas of interest, right? And the three things are, is the point of control, volume point of control, close to the V way up, close to a moving average or whatever, and say, wow, there's a lot of areas of interest right here. And that's what you're using the word key levels right there, right? Because there's a couple of areas of interest that are right next to each other.
Right. And I'll even drag another one down. So if we come back here, just using pure price action, because too many people ignore pure price action. If we look right here, I just dragged this yellow line down. This was a pullback, not only to the rotation zone concept, but this was a key, and based off a key close right here, a key daily close from the 30th of January, which is a key support level now. I now have that 50% level, the key support level, and a key moving average all clustering in that area. So that is an area I will choose not to ignore to take an action on again. Because whether you're watching one thing or another, the more things I found that cluster in an area, the stronger the potential for the market to react at that area.
So you're taking a support and resistance line, which all of us like to do, and then you're lining it up, and when it lines up with a couple of more areas of interest, that gives you even more confidence.
Correct. It gives just more reinforcement that that is an area I should not ignore.
Got it. Okay. All right. And then when you say, when you refer to clusters, is that the same thing or something different?
Clusters are just a group of, we can have the Fibonacci or the harmonic retracement, a harmonic extension, a support resistance line, and or a key moving average all lining up at the same area. That would be a cluster of potential things that we should not ignore. So whether I've one thing, there's not a cluster, but once you get multiples, it's a cluster.
I got it. I have a lot of questions. We don't have that much time, but I want to get this next one out. Do you care about volume at all or no?
I care from the fact that volume tends to follow trend. So I use it as a reinforcing indicator, and I will use it if we do hit a major level. I will use it because we should get, if that level is going to be of significance, we should get some kind of more substantial volume coming in, whether it's a bounce at that level or a break of that level, because a significant level, for example, this one I have on the chart that I lined up, this cluster, that does not mean we have to bounce there. It means, let's say we tear through there with a ton of volume. That is equally important, because what it means is, hey, for some reason, that was a key sell point. So we did not get a bounce there. It actually amplified the move. So I can tell that with volume also. But I'm not going to nitpick every single bar of volume and say, okay, this was slightly higher, this was slightly lower. I'm watching for volume at key areas.
I got it. That makes total sense. And and Bobby's referred to this before as well, and you did earlier today, this idea of rotation zones. What's a rotation zone, and how do you see it?
Okay, the rotation zones are the 8 EMA and 21, and you don't get hung up on, it could be the 20 EMA or and the 9 or the 10. It's an area, and that just so happens to be the ones that I found work the best for the testing I've done. But it can be within the 20 versus 21 or 19. But those are areas we don't trade crossovers or anything else, but it keeps me on the same side of the market. For example, when I do get a crossover, now it favors a bullish trend. So when the 8's above the 21, it favors a bullish trend. I then will use pullbacks into that area to watch for shorter term reversal signals. So back around what is that, the 19th of January, we got the cross, we pulled back. I'm watching for a shorter term entry signal for a rotation back up. We got the rotation back up. On the 25th, we dipped into it intraday. There was intraday rotation back up. On the 31st, we dipped into it intraday. There's a rotation back up. Then it took a while. We hovered above it for a while. So those are generally from trailing areas or managing positions. Dip back in it on the 10th, rotation back up. Now, one key thing is as long as we don't get a close below the 21, I am focused on more bullish plays. Yesterday, we closed below the 21, which not only triggered a double top pattern, but it put me, just from a rotation zone concept, it put me in neutral mode, which means I am not favoring one side of the market anymore. I will use other patterns that have triggered, or I will be watching for triggers in either way. So yesterday is neutral mode. Now, hypothetically, if we pop back up and closed in the rotation zone again without it crossing, it would put me back in bullish mode, which means I'm favoring bullish signals because I want to trade with the overall market trend.
That makes sense. So at what point does it reverse? In other words, the yellow line is going to have to go ahead and cross under for you to be in bear mode, right?
Right now, from the rotation zone concept, I'm in neutral mode, which means I can use other patterns also. And we triggered a bearish double top pattern yesterday. So now I am from the rotation zone, I'm in neutral mode. But from a key pattern perspective, I am in bearish mode, watching for pullbacks to some of these harmonic extensions down here. This little orange line, the 50% extension from the double top pattern, this second yellow line, and then the final red line. Those are from testing we've done. Those are the key levels that we will focus on for a continued decline, where we will take actions, and then it ties in with other key levels, which form clusters. So that is reinforcement of those actions.
Got it. And just to clarify, you have a harmonic range, and then you have a harmonic extension also on there.
I have harmonic retracements, which are the blue. So that's your traditional Fibonacci retracement tool that has been modified with the 12.5% intervals. Then we use the Fibonacci extension tool, but we use key extension levels depending on the patterns, or what I call just market extensions, which are the 12 and the 25% harmonic levels extended from key areas.
That makes sense. It's, when you look at someone's chart for the first time with all the lines, at first it's like, oh my gosh, what am I looking at? But you've explained it really nicely. So that's why I'm just I want to make sure everyone is hearing what I'm thinking.
No, and I will look at other people's charts and I'll be like, and I've been in this. So let's say I started in 92. So I'm 31 years into this, and I can still look at somebody's chart and go, what are you showing me here?
Yeah. No, for sure. I'm the exact same way. And in the opening range, we do a lot of experimentation. We just added Bollinger Bands as an example to a daily chart. And, we're going through this discovery process together as a community. Hey, is this helping us or not helping us? And so, we may never end with our experiments, but we come up with interesting conclusions. in your case, it seems like, hey, we've done a lot of different analysis. We've found basically the secret sauce that we like, and we're going to stick with it.
Yeah, we stick with stuff, and I'll still do. You know what? I've never stopped learning. It's why I love this career, and I can get introduced with stuff. The caveat is, and I'll tell people, find stuff that works and that you understand and that shifts probabilities in your favor, and then don't go chasing your tail. Yes, you can invest. I investigate new things. Somebody will, or I'll figure out something. I love Bollinger Bands, by the way. I actually use we actually have a key thing that I follow for triggering signals based off of that. But you know what? I don't need to look at there. There could be a new indicator every day that you could go down the rabbit hole of chasing. You don't need it. You need to keep it simple. Again, if I can explain it to a 10-year-old and they can sit with me for an hour and, I play video games, I get the concept. Well, fantastic. Then you can look at my charts and help me spot things, because you know what? I don't need to chase the indicator of the day.
Right. I got you. Now you have a daily up here, a daily candle chart. Is this your main time frame, or do you look at weekly, monthly, 10-minute, 15-minute?
Here's and this is sort of another secret sauce I found out. But all right, for daily trades, for daily swing trades, I use the weekly chart. Okay. So I will use the same concepts we just outlined: the key harmonics, the key support resistance, the key moving averages. I'll use the weekly chart, and then I'll drop down to the daily to find the trades like in the weekly rotation zone or at weekly key levels. Within the daily time frame, I drop down to the shorter times. Now, on shorter term traders, what I have found for my testing works best is roughly intervals of 3 to 4 chart time separation. So for intraday trading, I will use multiple time frames. However, I will still key everything off the daily chart. I'm finding the key levels off the daily chart, sometimes off the 4-hour chart, and then I will look to execute off the 5, the 15, the 1 hour, or the 4 hour. And that's where I get my 3 to 4 degrees of separation, because 3 times 5 is 15, 4 times 5 is 60, 4 times 60 is 4 hours. So I found those degrees of separation work the best if you're watching multiple time frames for things to line up.
So that's interesting. I'm thinking about that as you said it. You know, we on the opening range show, I use 10-minute candles to look for support and resistance, because in my mind, we only have an hour together, so we're looking for a trade to work quickly. And I have a 6 times multiple in my head. Like I want this 10-minute chart to give me the signal for a trade that's going to happen right away, or at least within 60 minutes.
So you're working with the 6 time, which is perfect, as long as you have something in your. What I tell people is stick to something. What I found works for me is that 3 to 4 time multiple. You might find that works to you a 6 time multiple. So you're going to stick to that methodology to come up with your consistency every day.
Yeah, that's awesome, man. We have a lot of comment. I'm so glad you're on the show. But I do, we're almost up against time, and I do want to give everybody an opportunity to be able to find you out there. What's the best way for folks to find you out there in the internet world?
The overall best way, if you're interested in just market analysis and technical analysis and sort of what we do on a daily basis, is go to YouTube and search for Path Trading Partners. I'm on there with a morning live stream and an afternoon live stream Monday through Friday, and I do a Sunday afternoon market preview to prep myself for the coming trading week. So it's 11 shows, and sometimes we do special things, so it's at least 11 shows a week. And then we're on Twitter at path_trading. You can follow me at MG Arnold at Twitter, and those are the best things to do.
Awesome. Hopefully, I think they're on the scroll there too. Fantastic. We do a poll question, Mike, in these shows, and we have a poll question, and I want to read the results. The poll question is this: I feel like Mike is more of a 25% said Star Trek guy, 16% said Star Wars guy, 8% said Battlestar Galactica guy, and 50% said all of the above.
Oh boy. Well, technically it would be all of the above, but I go by one of my handles has been speculator. And so people made years ago a superimposed my face on Spock's face, and I became Spockulator. So this was before even meme stuff and everything else. I have literally my head on Spock's body, and I was transformed into Spockulator years ago. So the people who voted on Star Trek are probably the most correct.
That's awesome. And we got I had Chino to thank for that poll question, by the way. But
oh boy,
awesome.
I knew he'd get in here somehow.
In any event, it's been a pleasure. I learned a lot. I really appreciate you taking the time to be with us today, Mike.
Well, thank you so much for having me, and thank you for producing this wonderful show.
Yeah, and we will hopefully see you again soon. In the meantime, folks, I do want to remind everybody the most important message: be safe out there, be good to each other. Thank you for coming.